What's up everybody, Gen X Dividend Investor here. I hope everyone had a safe and fun 4th of July. In this video I tell you why earnings are so critical to dividend investors. I'll also share a recent clip from a well-known professor at a top-ranked business school that you'll want to hear. Finally, I'll show you a valuable discussion that we just had on my Dividend Discord, so I recommend you watch this from start to end. But first I wanted to do a shout out to KeithMan5000, who just clicked that join button to become my latest channel member. Thanks, I really appreciate all you folks for joining my team. Okay, let's get into it. So pretty much all dividend investors want to see a growing and sustainable dividend over time. And given that, the question then becomes, how can we identify companies that have sustainable and growing dividend potential? Well, the healthier the balance sheet, income statement, and cash flow statement that a company has, the better the odds are that they'll have a growing dividend. And since dividends tend to be paid out of earnings, aka net income, then that means that we want to see our companies have solid earnings growth. Earnings are also known as profits, or bottom line numbers, and are a measure of how much money a company has left after subtracting all their expenses. So the top of the income statement shows the revenue or sales numbers a company has over time, the middle part of the income statement shows various expenses the company has, and the bottom line number shows the profit of what's left after you subtract the expenses from the revenue numbers. Another name for the income statement is a profit and loss statement, since it summarizes a company's income and expenses over a period of time. As an example, if a company ABC has $10 billion in sales and $9 billion in expenses, then they end with $1 billion of profit. If they paid $300 million of dividends from that $1 billion of earnings, then they'd have a nice dividend payout ratio of 30%, since 300 mil of divvies divided by 1 bill of income is 30%. I say nice because the lower the payout ratio, the easier it is for a company to pay their dividends, and the more room they'll have to be able to hike their dividend in the future. But if your payout ratio is high, let's say 85%, then that means you're spending 85% of your profits on divvies, and it may be hard to keep paying out and increasing, not to mention it leaves very little left over for anything else. Some companies actually average high payout ratios, like tobacco companies, because they've got a really good handle on their cash flow and expenses, and their businesses generally aren't being radically interrupted by new things other than regulations. One irony of tobacco regulations is that in the US they've made it so that tobacco companies can't really advertise most of their products in movies or TV or other media regulated by the Federal Communications Commission, which means that the government has effectively created industries which are kind of insulated from new competition, since new competitors can't advertise, and the existing players already have brand awareness. Anyway, a dividend payout ratio ultimately just shows the percentage of a company's earnings that are paid out as dividends to shareholders. That means that a payout ratio greater than 100% suggests that a company is paying out more in dividends than its earnings can support, which probably means they're taking on debt to pay their dividends, and obviously that isn't sustainable over the long term. One thing I've noticed with long-term blue-chip companies is that they tend to be pretty consistent with their payout ratios over long periods of time, and I've seen that the amount of dividend growth they do seems to correlate to how fast their earnings are growing. And that kind of makes sense since we just explained how dividends are paid out of earnings, and so if your earnings go up, then you also have more you can pay out, which often translates into bigger dividend hikes happening. Thus, earnings growth can help maintain or lower the dividend payout ratio, and those low payout ratios suggest that the company is retaining enough earnings to reinvest in growth opportunities while still paying dividends, which is a sign of financial health and sustainability. That all being said, some industries are a bit different. For example, when you evaluate real estate investment trusts, aka REITs, normal metrics like earnings and earnings per share and PEs and such generally aren't reliable. And a reason they aren't reliable is because REITs own and operate real estate properties, which means they probably have significant depreciation and amortization expenses. Depreciation is the process used to deduct the costs of buying and improving a rental property. So rather than taking one large deduction in the year you buy or improve the property, depreciation distributes the deduction across the useful life of the property. And then amortization refers to the process of gradually paying off a loan over time through regular payments. Both depreciation and amortization are non-cash expenses that reduce net income, which is what traditional earnings measure. However, real estate often appreciates over time, making depreciation a poor indicator of the REIT's actual performance and cash flow. Or to say that a bit differently, depreciation is the allocation of the cost of a tangible asset, like buildings, machinery, or equipment, over its useful life. It reduces net income on the income statement, but it does not involve an actual cash outflow during the period it is recorded. The purpose of it is to reflect the wear and tear or obsolescence of an asset over time, matching the expense with the revenue generated by the asset. And similar to depreciation, amortization reduces net income without a corresponding cash outflow during the period. So both those expenses appear on the income statement and reduce net income, but because they are non-cash expenses, both depreciation and amortization are added back to net income in the operating activities section of the cash flow statement to reconcile net income to net cash provided by operating activities. By reducing net income, those expenses impact a company's reported profitability, but do not affect its cash flow directly. TLDR, with the REITs we look at FFO or funds from operations instead of earnings because FFO adjusts net income by adding back depreciation and amortization and excludes gains or losses on property sales. This ultimately gives us a better picture of the REIT's operating performance and its ability to generate cash from operations. You might also look at adjusted funds from operations or AFFO because it goes a step further by making additional adjustments to FFO, such as subtracting maintenance capital expenditures and straightlining of rents. This provides an even clearer view of the REIT's sustainable cash flow and its ability to pay dividends. And since REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, then investors are often more interested in the REIT's ability to generate cash to support their dividend payments rather than look at traditional earnings. Thus, by focusing on FFO and AFFO, investors get a more accurate understanding of a REIT's operational performance and cash flow generation, which are obviously crucial for assessing its dividend-paying capacity and overall financial health. That means that instead of using PEs, you might use price to FFO ratios to gauge whether a REIT is cheap or expensive relative to its peers or its historical trends. Moving on, if a company is paying dividends to shareholders, then that means that company isn't using that portion of their earnings to invest in the business. But as Warren Buffett said, it makes sense to pay a dividend if the company's execs can't more efficiently reinvest the money into their business. Some people incorrectly say that it's always smarter to invest into the business rather than pay a dividend, but watch my video I did called Why Berkshire Hathaway Will Eventually Pay Dividends, where I show videos of Buffett talking and explaining when it makes sense to pay a dividend versus when it doesn't make sense. The reality is that since Buffett is one of the most effective capital allocators in financial history, it makes sense that Berkshire doesn't pay dividends. Remember that a key responsibility for a company's management team is to determine how to allocate capital, i.e. how to spend and invest their money and financial resources in ways that will increase their company's efficiencies and maximize their profits. Anyway, dividends can also be paid out of retained earnings, which are accumulated profits from previous years that have not been distributed to shareholders. And in rare cases, a company may borrow money to pay dividends, though that's not generally considered a sustainable practice, and it can indicate that the company is not generating enough profits to support its dividend policy. Some companies might even have to sell some of their assets to generate enough cash to pay dividends, though that doesn't happen often and obviously indicates that a company may be facing financial challenges. So at the end of the day, companies tend to pay their divvies out of their profits, and divvies are seen as a reward to shareholders for their investment in a company and are usually paid quarterly based on the amount of the shares they own. For investors, dividends represent an asset, but for the company, they are shown as a liability. Hopefully now you're getting a picture as to why earnings growth is critical for dividend-paying stocks, because without enough earnings it means a company will struggle to keep paying dividends, leading to probable dividend cuts or suspensions. Plus, earnings growth often indicate a company's in good financial health and that it has an effective management team, all of which reassures investors that the company can continue to generate the profits and cash flow that is necessary to pay those sweet dividend payments. And as investors see consistent earnings growth, they start gaining confidence in a company's long-term prospects, which in turn often mean higher stock prices, which makes it a double win for us dividend investors. I mean, we get stock appreciation and we get dividend income. And companies with strong earnings growth and reliable dividends are often favored by income investors who want that stable and growing income stream, which also can mean that quality dividend stock prices get more supported in crashes and thus usually have less volatility. Of course, one thing we all deal with is inflation, and that's another reason why it's critical that we see good earnings growth in our companies, because that often translates to higher dividend hikes, and that allows our increased dividend to outpace inflation as we get more income. And as I've shown you in multiple videos, the rate of dividend hikes, on average, has outpaced inflation, on average, over long periods of time in multiple markets around the world. Now, us dividend growth investors also like to see our stock prices trend up, and good earnings growth also usually means that a company is reinvesting some of their profits back into their business to fuel more growth, and growth usually means more earnings, higher stock prices, and more divvies. It's a beautiful cycle. Another reason why earnings are critical is because good earnings growth messages to investors that a company's yield, even high ones, are supported enough by underlying profitability, and thus the risk of dividend cut is lower. Another benefit of earnings growth is that qualified dividend income is often taxed at a lower rate than ordinary income, and so companies with growing earnings and dividends offer tax-efficient income streams to investors, which is something people will value when doing tax planning. Plus, earnings growth generally means faster dividend snowball compounding growth as investors reinvest their dividends to buy more and more shares. Now, I personally like to focus on US dividend stocks for reasons called out in this analysis that was just published by UBS, which found that US stocks have the lowest probability of a dividend cut. So whereas they found a 21.8% probability of dividend cut when looking across all markets around the world, the probability in the US is only at 6.6%. Another interesting analysis that was just published said that for the rest of 2024, the continued uncertainty over the economy and the timing of expected interest rate cuts will likely limit the size of dividend increases. Absent an economic or geopolitical event, dividend growth is expected to selectively continue. S&P 500 large caps have performed better than most in the first half of 2024, as the Magnificent Seven have dominated the returns. The index is expected to post a 6% increase in dividend payments for 2024 compared to its 5.1% increase in 2023 and the 10.8% increase seen in 2022. So the TLDR is that we should continue to see dividend increases going forward at a slightly faster pace than we saw them last year, but slower than seen in 2022. And that sounds peachy keen to me. I love the fact that I simply hold decent companies and that they can keep paying me a share of their profits in the form of a dividend. And if companies that don't pay dividends last long enough, then it's almost a certainty that they will eventually start paying dividends. Like this year we saw Meta, Salesforce, Google, and others start paying dividends. I guess those companies are doing that because dividends are irrelevant. Anyway, circling back, how do we check earnings growth of a company over time? Well, my favorite way is to use FASTgraphs, as it lets you see historical earnings growth over various periods of time, as well as estimates future earnings growth, which is also important to see. And note, I'm an affiliate of FASTgraphs. Okay, here's a FASTgraphs of Procter & Gamble, which I'm long in, going back until 2004. Quickly, I can see that PG looks expensive right now, since its black price line is higher than both its blue PE trend line and its orange intrinsic value line. I can also see that over the last 20 or so years, the PG has had a 5.82% annualized earnings growth rate. And as I previously said, dividend growth follows earnings growth, and you can visually see that on this graph. In this case, the white line represents dividends being paid out, and if you look at a bunch of FASTgraphs, like I have, you'll notice similar trends of white line slope following the orange line slope. Remember from your old math classes that slope is rise over run, or like the steepness of the line. Okay, let's look at how PG's earnings growth rate changes if we just look over the last 5 years. Now we see growth is a bit higher at 6.41% annualized, more than the 5.82% we just saw over a longer time frame, which implies its growth has actually improved more recently, which is great to see. Let's check what FASTgraphs estimates that Procter's go-forward earnings will look like. This shows that we'll see an uptick in performance with earnings growth at an annualized 6.55%. Nice. Of course, that's just an estimate. Let's compare Procter & Gamble to another company I'm long in, which is Microsoft, an obvious faster grower. Again, we see a stock that looks way overpriced, and clearly the AI hype is helping it. Microsoft has had a 2-decade annualized growth of 12.78%, which is incredible. If we just look at the last 5 years, then we see an even faster earnings growth rate at 15.15% annualized. Amazing. Now let's look at what they estimate Microsoft's go-forward earnings growth rate will be. What we see is a really huge estimate of 16.59% annualized. Crazy. I guess Microsoft was in the right place at the right time with their OpenAI ChatGPT investment, and Microsoft is a top 3 position for me these days. Now if we looked at FASTgraphs for a utility stock, like Con Ed, we would see a lower earnings growth rate along with a lower dividend CAGR percentage, as we would expect. Anyway, hopefully now you can understand why earnings are so critical to dividend investors. Moving on, I want to show you why I recommend that you join my free Dividend Discord chat server. So this morning on Tuesday the 2nd, as I was working on this part of the video, I decided to quickly check what people were talking about on my Discord. If you've not used Discord, it's just a way for people to chat about specific topics on servers people set up, like mine for dividend investing. Well, today, a new user to my Discord named Mongo Joe asked where the best place was to find out about dividend hikes, and another user named TG530 responded that there's a channel on my server called Dividend Hikes, which automatically posts about them. Mongo Joe responded that he saw that, and wondered if there were any other places that people recommended. So I suggested Seeking Alpha, which is probably the best site on the internet when it comes to stock investing, and note I'm an affiliate of Seeking Alpha, because I really value some of their articles and associated comments. Mongo Joe responded that he'd have to look harder on Seeking Alpha, because he was searching for the SCHD hike that everyone was talking about, but he couldn't find it. So I shared SCHD's webpage, which gets updated whenever new dividend payments are ready to go out. I also explained that Fidelity is another place he could look. Then I said that ETFs aren't like single stocks, since single stock companies do press releases when they do a dividend hike, but that sometimes that hike info may be buried within the article. And as an example, I showed him how last year Goldman Sachs did a 10% dividend hike, and their press release was titled, "Goldman Sachs announces 10% dividend increase." But then this year Goldman did a 9.1% dividend hike, which just happened days ago, and I showed him the article they announced it in, which was titled, "Goldman Sachs Statement on Stress Capital Buffer." So in that case, Goldman's info about their dividend hike came as part of their press release about them passing their annual federal stress test. And side note, I read that the 6 major banks of Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, Morgan Stanley, and Wells Fargo increased their annual dividends by $3.5 billion with an average increase of 9.1%. That got me thinking that don't you find it interesting that some of the world's most brilliant financial minds, i.e. the execs leading the largest banks in the US, all pay dividends? It kind of makes you think dividends matter. I mean, dividend irrelevance theory suggests that a company's dividend payments don't add value to a company's stock price, and yet Jamie Dimon and those other financial whizzes all push for dividends. Why would they do that? Is it because they realize that a lot of investors value dividends? And even if you think those investors are irrational, the reality is that lots of investor demand translates into more buying, which translates into upward pressure on stock prices. Not so irrelevant if you ask me. Dividend irrelevance theory also seems to argue that dividends hurt a company since that money would be better spent if it were just reinvested in the company, though I've already explained why Buffett has disagreed with that statement. Thus, ignoring the intrinsic demand reality that comes from decent dividend stocks seems short-sighted for dividend haters. Of course, you shouldn't buy a stock just because it has a dividend, but you also shouldn't be blind to market demand realities. But hey, you do you. I say all that a bit tongue-in-cheek because I personally advocate that people invest in quality companies regardless if they pay a dividend, because I believe investing in quality companies is still the best long-term approach to wealth creation for most people out there. And a great indicator if a company is quality is if it has a history of increasing earnings over time, along with if you believe that earnings growth can continue into the future. Anyway, back to the chat on my dividend Discord. I then went on to explain that ETFs usually update their site with their next distribution amount like I originally shared for SCHD, but that if you follow SCHD on Seeking Alpha, then you can get notified about its dividend payout amounts. My point in sharing that Discord discussion is because it's indicative of the type of rich information people share in my dividend Discord, and people are talking on it 24/7 because I have over 10,000 dividend investors on it from 80 countries around the world. I actually have dozens of private country chat channels on my server that I can add people to if they request it. So like I have a Netherlands channel where people type in Dutch, amongst a bunch of others. All the public channels are in English, each of which has a specific topic it's dedicated to. So while my server is focused on dividend investing, I also have channels for movies and one for video games and another for sports and a bunch of other topics. And since I want my Discord to be a positive environment experience, I have a rule that says no talking politics or any other divisive topics, as I want to keep my server as a drama-free, friendly place where people are there because they want to talk about investing or their careers or movies or whatever, moderated by me and a longtime subscriber friend of mine named Men8V, who is also the guy that I've been programming my spreadsheet with for years. I work hard to keep my dividend Discord free from bots and scammers, since it isn't behind a paywall, so before I authorize your access to my server, I'll sometimes chat with you to try to ensure that you're a legit person and aren't there to scam or self-promote. My server requires that you use an authenticated Discord account, which means a real phone number that I don't see, but that Discord is verified as legit. So I recommend you join up today, and if you have problems gaining access to my server, then leave me a message here or on any of my social media so I can help you try to join. Regardless if you join or not, what I do strongly recommend is that you figure out how you can spend less than you make and then just continually invest in decent stuff for the remainder of your life. Take a listen to this short clip from a professor at a top business school.
And set yourself on a path for some sort of financial security, because here's the definition of rich. It's passive income that's greater than your burn. I have a close friend who runs the M&A group at a large bulge bracket investment bank. He makes between $4 and $14 million a year. He pays 54% a year in taxes because he's a super earner. Super owners don't pay taxes. Super earners pay a ridiculous amount of tax. So he walks home with somewhere between $2 million and $7 million a year. Between his ex-wife, his alimony, his child support, his home in the Hamptons, his FlexJet card, and the trappings of a master of the universe life, which he feels justifiably he needs to have, he doesn't save a lot of money. He has nowhere near the passive income that he would need to support this lifestyle. And I can tell you firsthand, he spends a lot of nights staring at the ceiling, very stressed. Other example, my father, who's turning 94 in 3 months. Between his pension from the Royal Navy, Social Security, and he owns 17 washing machines and dryers in trailer parks where he collects the quarters every day, he makes $52,000 a year. He spends $48,000 a year. He has $52,000 in passive income a year. He spends $48,000. My father is rich. My father never needs to work again, never needs to worry about money, has a total absence of economic security. He is rich. So rich is passive income that's greater than your burn. So you just need to put yourself on a path towards that and have an adult conversation around not only what you earn, but what you spend.
So there are some real gems in there, with the key one being that you gotta spend less than you make and that you gotta invest. In fact, in an article by that same professor, he said that if you can just save and invest $100 a month, then that will immediately put you in the top 10% of most financially responsible people in America, as most people don't do that. Basically, if you save and invest $100 a month over a 45-year period, and you generate an average annual return of 8% in a stock portfolio, which is a bit below the market's long-term average, then you could end up with a portfolio worth almost $500 grand. And according to the Federal Reserve, that's more than twice as much as the median $200,000 retirement savings balance amongst Americans aged 65 to 74. Another important point the professor called out was how important passive income is. Now, one of his examples was about his dad's income, most of which he called passive but really wasn't in my opinion. but there's no doubt in anyone's mind that dividends are passive income. And with that, I'd like to close things off and do a shout out to Mongo Joe, who recently grabbed an open Patreon aristocrat seat. And everyone should consider using my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. I'll also recommend checking out my Seeking Alpha affiliate link, as new users can get discounts for signing up. Plus, take a look at my Patreon seats to see if there are any that you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks, including a badge icon that is placed by your comments on my videos and which levels up over time as long as you're a member, and you get the ability to vote on which thumbnails I use for my next video, and you get to watch my videos about a day before I release them publicly. And I do a shout out when you join up, as you heard in the beginning of this video. But whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 81 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.